Filing taxes is one of those areas in financial planning that brings a lot of anxiety. And it's one of those areas that we get the most questions on, particularly after the beginning of the year. What can I do to influence my tax return that I'm filing for last year? So we'll dive into that topic today.
Okay, so Spencer, filing taxes, it's challenging. You got to round up a bunch of documents. You might have earnings. You'll have, if you've got distributions from an IRA, you'll have those. You might have interest from a bank account, mortgage statements, charitable giving. There's a whole lot that goes into filing our taxes. And oftentimes when the beginning of the year comes, there's this level of stress and anxiety that comes. And then it's, oh my gosh, do I owe taxes? And then what can I do if I did owe taxes? And so today we want to jump into what people can do and not do when it comes time to, it's 2024 now, to look back and say, okay, before I file my taxes, is there anything that I can do to my 2023 return so that I don't have to bear as much of a tax burden? So you want to launch us in, what are some of those things that taxpayers can do and cannot do?
Well, there's not a whole lot that folks can do. There are a few things, but it's kind of like boarding an airplane. You know, there's not a whole lot that you can do to make sure that the airplane's going to get there on time. And that's one of those things that's difficult for us to control. We like to control everything. And so as we look at these, we kind of have to just say that there's not as much as maybe we'd like to be able to control after the beginning of the year. So the first one, though, is contribute to an IRA. This applies to a handful of people, not a whole lot of people, honestly, because oftentimes the retirement contributions that we have clients making go through their 401k, their 403b, their employer-sponsored plan, whether that's a simple IRA or something else. So you can make up into April 15th, or your tax filing deadline, you can make those contributions to a traditional IRA. Now, there are earnings limitations on those, and we'll dive into those here in a moment. But that's one of the key things if we're looking at trying to knock down that taxable income, that key number, so that we have less tax due. That's one of the levers that sometimes we can pull. Mm-hmm.
So walk us through some of those earnings limits. You have to have earned income for the year. So even if you have a distribution from your IRA because of required minimum distributions, that's not earned income.
Right.
So just because you have money flowing in does not mean that you've earned income to be able to contribute to that IRA.
Exactly. And this is W-2 earnings, so that would be issued by your employer, or could be 1099 earnings if you are a consultant and you are paid and you're paid via 1099 and you have to pay the federal government. Oh joy, both sides of FICA there. So you have to have that earned income, and you have to have at least as much earned income as you're hoping to make as that contribution. So the 2023 contribution limit, $6,500 for those of us who are under age 50. Once you attain that age, then you've got an extra $1,000 that you can make as a contribution. Now, I think the thing that we want to recognize here is if you don't have access to an employer-sponsored plan, let's just say you nor your spouse have access to an employer-sponsored plan, then it's a really simple decision because you can make a contribution to a traditional IRA. There are no earnings limits there. Now, the thing where it gets a little bit funky is if your spouse, one spouse or the other, has an employer-sponsored plan, a 401k, 403b, something like that, and the other spouse doesn't. Well, the spouse who does not, then he or she has the same Roth IRA contribution limits with respect to the earnings that they have. So if we look at that for 2023, if you are a single filer, then you have to have modified adjusted gross income that would be south of $73,000 up to $83,000. There would be a partial deduction and then no deduction after that. If you are married filing joint there and you both have access to employer-sponsored plans, then you've got to make less than $116,000 of modified adjusted gross income. There's a phase out there for about $20,000 where if you make north of $136,000 and both of you have access again, then you can't make that contribution. And then the one that is a little bit dicey that we talked about there, one has access, one does not. Again, the one who does not have access, if you have modified adjusted gross income and you are married filing joint of 218 or less, then you can make a full contribution. There's a phase out between 218 and 228 there. So lots of different details. We'll post a link in the show notes so that you can see this visually. There are some moving parts to this. But generally speaking, again, just think if you do not have access in your family household to any kind of employer-sponsored plan, then contributing via a traditional IRA, you get deductibility there. Now, there's another way that you could do this. You could make a non-deductible contribution to a traditional IRA and do a backdoor Roth conversion, and that will be the topic for another day. But it can be made. You just have to note that if you make one, you're not going to get a deduction on that. So it's not going to help your tax bill in 2023.
Right. Okay, so we've talked about contributing to a traditional IRA. Could knock down that taxable income that you have and then thereby lower your tax bill.
Right.
What's that next one? We've got the health savings account. There's a couple of caveats here with that health savings account. So walk us through this one.
Well, the thing that we always have to remember with a health savings account is that we have to have an eligible health insurance plan that we are a part of to be able to make the health savings account contribution in a given year. And what that typically means to have an HSA eligible plan is that we have a fairly high deductible. Now, there's other provisions within that the plan has to jump through, but generally speaking, it's rather high deductible, and it's designed in such a way that we can make that HSA contribution. And if we think about it, then we've got a capacity actually to make a pretty significant contribution relative to knocking down, again, our taxable income. The individual can make a contribution up to $3,850 for 2023. A family can make up to $7,750. And then for those who are age 55 or older, they can contribute an extra $1,000. Now, the thing that we also have to remind ourselves is you can't have signed up for Medicare Part A. So you don't have to have earned income. You could retire at 62, let's just say in this scenario, and be age 63. Have no earned income, and if your plan is eligible, you could make the contribution. But once you attain age 65, most people sign up for Medicare Part A, and then they're excluded from making those HSA contributions. The beautiful thing about HSA contributions is you're lowering your taxable income there on a dollar-for-dollar basis, and then if you pull those resources out later down the road, you're not paying any tax on those if they are eligible distributions. So that HSA is a really valuable option if everything else lines up for you to be able to make that contribution.
Right. And the other thing we would say here is if both spouses are covered by a health insurance plan that has an HSA eligible, it's a family limit.
Right.
So just because both of you have an HSA eligible plan doesn't mean you can contribute $14,000.
Right.
As a family, including the employer contributions, you can only contribute up to $7,750.
And it's a great point because we have employers here in the area that will contribute $1,000, $2,000 to that plan. They'll do some kind of matching. So we've got to be careful when we've got all of those kind of moving parts so that we don't over contribute, because it's not a fun calculation and it's also penalized fairly vigorously until you get rid of the excess contribution.
Yeah. All right. So next, let's take a look at SEP IRAs. Walk us through just a little bit of how you can make a SEP IRA contribution in the new year.
So a SEP IRA plan, essentially, most of the time it's used for folks that are solo consultants or really they're self-employed. There are ways that you can set up a SEP IRA plan with multiple employees. We don't see that as often. But that SEP IRA, you can make a contribution and it is only on the employer side. Typically, this amounts to about 20% of your Schedule C income as a limitation. So you can make that employer contribution, and again, up to the point that you file your taxes, I think including extensions. Now, your solo 401k plan, it's somewhat similar, but your solo 401k, you have more capacity to make a bigger contribution because you're making an employee and an employer contribution. So your employee contribution can be up to that same amount that you could contribute if you were an employee of a larger institution that had a 401k. The employer side is very similar to the SEP IRA in that you have more or less 20%. It's a little bit less than that, but more or less about 20% of the earnings that you would have in Schedule C.
Okay. So the next one we think about is just, are you going to be able to itemize your deductions, or are you going to take a standard deduction? And I think there's not anything that you can do to make charitable gifts in the new year that count towards the last year. But if you know that the previous year you maybe gave a little bit extra, maybe you had a little bit more interest, maybe it's taking a look, do you qualify for that itemized deduction?
It's looking to make sure that you know whether you qualify or not, and then gathering those documents, like you said, because the IRS expects that you're going to have all the documentation that you need by the time you file taxes. So technically speaking, you're supposed to have all of those charitable deduction receipts, all of that documentation by the time you file your taxes. So starting to gather that, compile that is an important step as well.
Yeah. All right, so Spencer, what are some of the last things that people can do in the new year with their taxes?
Well, of course, you want to make sure that you review all of the possible credits and deductions that you could receive. So, these would be things like deductions for education or energy or earned income tax credit or other ones that may not be quite as typical or quite as much on the mind of most folks there. So make sure that you know those that you could be hoping to receive there and applying for. You would also want to think about filing an extension. Of course, if you can't get everything together by April 15th, or if you are one of those folks who lives in Massachusetts or Maine, you've got until April 17th because you've declared 2 more holidays than the rest of us. You've got Patriots Day and Emancipation Day, and so it's April 17th for you folks. But for the rest of us, it's April 15th this year. And so we want to make sure that if an extension needs to be filed, that you do so, or that if you need to make any more estimated tax payments, that you go ahead and do that, because if you have not made those estimated tax payments, you're not current with those, you don't want to wait until October 14th with that extension and then present your return and pay for them then, because there will be some penalties.
Yeah. All right, so we've walked through some things that you can do that could help. What are some things that we cannot do? So the first one, contribute to an employer-sponsored plan. Talk us through that.
Yeah, so employer-sponsored plan, if you have a 401k with your employer or a simple IRA or 403b, these types of plans, everything needs to have been made, by December 31st. So, and you would need to have worked with your HR department on this to tell them, here's the amount that I want withheld from my payroll and those kinds of different things. So we can't go back unless you've got a time machine. We can't go back and really have an impact there.
Yeah. So the next one, we've talked about you can't make a gift for last year retroactively. What about home improvements? Mm-hmm. If I had solar panels put on my home January 1st, that doesn't count for last year.
Technically, no. So you've got to have done everything with those deductions or credits last year.
Okay.
In that calendar year.
Okay. What about selling investments? Can I sell anything this year and book a loss for last year?
Again, no. We got a lot of bad news. There's a lot of things that you can't do here. We can't adjust the amount of gains or losses that you have by selling securities or maneuvering in that new year.
Okay. Property taxes. Mm-hmm. Anything there?
No, nothing there. Again, what we would counsel you is to do some planning along the way so that if you have the opportunity, for some of our clients, they have an opportunity to double up, to bunch those property taxes, pay 2 years in 1 year. And so that might work out where you pay in February and in November, in 1 year, and then you have a year that's off if you're trying to clump your expenses together so you get a higher level of deduction. But you can't do that retroactively. We can't go back and say, I'm going to pay January 5th and apply it to last year. That doesn't work.
Okay. Well, so let's think about it on a flip side. Mm-hmm. If we come to the end of the year, the tax filing end of the year, It's April 10th, and I realize, oh my gosh, my income was significantly lower. Mm-hmm. Can I make a Roth conversion?
No, it doesn't help you. Just like trying to harvest long-term capital gains or short-term capital gains at that point, it doesn't help you. There's nothing that we can do there. So we need to do that Roth conversion again by the end of the year.
Okay. Walk us through a couple of these other ones. Deductible medical care expenses, retroactively claiming Social Security, adopting a child, having a child, anything?
No, and no. And shame on you for even thinking about having a child just so you can lower your tax bill, or adopting a child so you can lower your tax bill for that matter. But no, in all seriousness, all of these things, they're just going to apply for that given year when they happen. That's when in that calendar year, it would be if it was in February of 2024, we'd be looking at 2024's tax bill tax return that we would be filing in the first quarter of 2025, sadly enough.
Okay. Get married?
Get married does not help you.
Okay.
Yeah.
Well, I tried.
Yes, you did. And lots of bad news and only a few glimmers of hope there. But again, this is something that we do our best. We recognize that it can be a process there. There are limitations to what we can control. And so if we go into it with a proper perspective and knowing that if we owe a little bit more or we receive a little bit more in terms of our refund, it's okay.
Yeah. All right. So Spencer, we've walked through several things that you can do in 2024 to reduce your tax burden possibly in 2023. But the reality is a lot of these things are already out of our hands. So really what we need to think about is having a proactive tax plan. What are we doing now for this year's income within 2024? There's not a whole lot of things once the new year rolls over that you can do for this year. As we say with any of these things, especially with taxes, you need to consult a tax professional. Clients, we would love to talk with you through your tax plan, but again, consult with your financial advisor with your specific situation. And with that, we'll see you next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.